Okay, we're going to go ahead and get started. Welcome to week 9 of PSC 603 Budgeting and Fiscal Administration. It is March 21st, so it's been a while since we've all been together, and I want to thank everybody for their patience and for their hard work. And I hope that everybody's had a good spring break and is doing well in their other classes this semester. Tonight, we are going to focus on revenues, both in the lecture as well as in the lab portion, which immediately follows this class. And looking forward to some great discussion with respect to the topics that we're going to cover tonight. I imagine that most of y'all, if not all of y'all, can relate personally to the topics that we're going to talk about as taxpayers, and as well as for those of you who do work in government with respect to the challenges you have when it comes to revenue. So let me bring up the next slide. What we're going to focus on tonight in the part 1 of revenues is we're going to go through chapters 8 through 11. So originally the plan was for me to cover chapters 8 through 10 in a lecture that I would have sent out remotely. I would have sent out through YouTube last week. However, as I looked over this material, I realized it might be best for me to wait on it and wait to kind of combine this material differently. I was kind of working based off the past syllabus, and so I kind of looked and realized that if I can spend a good amount of time talking and answering questions with respect to chapter 8 on taxation, it really then ties into the 3 chapters following it that have to do with income taxes, the taxes on goods and services, also known as sales taxes or value-added taxes, and chapter 11 dealing with property taxes. So I made the decision to kind of adjust it a little bit, and I think we'll have a good conversation tonight. And then immediately following this lecture, we will do the lab exercise on revenues. And I emailed out the practice spreadsheet for that. I will send out the that practice spreadsheet will also, there will be a different version of that y'all will receive tonight, which will be your assignment spreadsheet. Y'all will receive it either tonight or tomorrow morning, and I will extend the deadline on completing that assignment. The other thing about also that I just want to cover as a course adjustment is that I am looking to do a live lab session next Monday night, probably around 7 to 7:30 p.m. I could record the lab, but I think it would be best if I did a live lab. So you'll get 2 live. I'm going to try to do my best, at least for the next couple of weeks, to be able to do the lab sessions live, even if I can't necessarily do the lectures live, so I can work with you especially as we get into the forecasting portion of the examples after we finish with revenues. So I hope that that's helpful to everybody. So, are there any questions? Yes, Brantley.
Do you have any clarification to offer on the paper? And
Brantley, I'm not able to hear you.
Can you hear me now?
Okay, hold on 1 second. It may be me. Hold on 1 second.
Can anyone else hear me?
I can hear you.
I can hear you.
I can hear you.
Okay, now I can hear you, Brantley. Go ahead.
Okay, yeah. I was just curious if you had any clarification to offer on the paper and the budget project, details, timeline, just anything like that.
Yeah, I need to, thank you for that, Brantley. What I'm going to do is get something out to y'all, hopefully no later than Wednesday, and it'll explain everything. But I've been trying. I apologize. We've had some issues at work. For those of you who don't know, we went through kind of a management changeover, a kind of a very quick management changeover in my jurisdiction here last couple of weeks, last couple of months, and I've been trying to balance that and this, and also getting the budget ready for next fiscal year. So I will send that information out. I know that those deadlines are coming. Those deadlines will be extended. So don't worry about that. And anything that I do will reduce the scope of the project rather than increase it. So it will not be to add more work. But I will get that out to y'all tomorrow or Wednesday. But the lab assignment, I'll make sure is out, excuse me, by tomorrow morning.
Thank you.
Anybody else?
Yes, I have a question.
Okay.
So, with the paper, are we still going to be working in groups?
There's the, I believe, yes, I believe so. Are you in a group?
Well, we had, we kind of picked our own groups before you came aboard.
Right.
But I got so confused with it. I don't know where that, are we still, I think our group should have sent you something to tell you what groups.
You did.
Okay.
You did. So I will check back in on that before I send anything else out.
Okay.
Okay. Are there any other questions? Okay. So let's get into taxation, everybody's favorite topic. So really what I want to talk about are some key characteristics of taxation, but I want to start off with some background about taxation. We are obviously, all of us as adults and as citizens, whether as income earners, as consumers, as property owners, utility, all of us pay taxes in one shape, manner, or form. We pay also taxes to multiple levels of government. We pay taxes at a local level, we pay taxes at the state level, we pay taxes at the federal level. And that was not necessarily always the case in our country. Originally, taxation powers, if you've studied constitutional history, you know that while the federal government did have power to levy taxes, they were incredibly limited in how they could do it. And there were various aspects to that we'll talk about later. But for example, it was the whole, even if they had the constitutional authority to be able to levy certain types of taxes, there was the administration of actually being able to enable collection. So initially, there were very minimal ways that they could assess taxes. I think in the chapter on goods and services, it talks about various excise taxes and import taxes. Those were, many of the initial taxes were tied to importing, to duties, or on exports. They were tied to things where they could more easily than in other ways facilitate the application or the administration of the tax associated with economic activity. Because the important thing to understand with respect to taxes is that all forms of taxation are tied to some type of economic activity, whether it's the income you earn, your consumption as a consumer, or your investments in property, whether it be land or homes or stocks or whatever the case may be. And so taxation has to flow through some kind of economic channel. Historically, taxing, the original tax, of course, we can think of goes to the concepts of early ages where there was sharing, where there was required distribution of whatever commodity that somebody had. Obviously, in the early ages, not everybody had currency or even precious metals. So it could potentially be crops, livestock, other types of goods were considered currency, that being back in the barter days, but also could be, and so they were shared based on the institution that oversaw the given land. We also, of course, and while it's not a tax, we are familiar, many of us are familiar with the principle of tithing. So these, so the idea of being required to make a contribution through some means of economic activity to the government for the provision of government service is definitely been around for thousands of years, and it's an important element to government finance, because As I prepare a budget right now, I'm meeting with departments to go over their expenditures. Most of the departments that I have in the city, particularly in general government, themselves do not produce revenue, like the police department or the fire department or the public works department. And so as I work to bring all of these different departments together and put them in the general fund to balance a budget, I have to look at it from the perspective of what can we actually afford? And that's all dependent upon being accurate and reasonable with respect to our receipt of incomes and receipt of revenues. And that's where, of course, most of our revenues come from various types of taxation. And when we go into the revenues example, you'll see just how broad the scope of revenues can be in government. And there'll be a little bit that I'll talk about in the lab to kind of give you a broader understanding of revenue. So we know that our modern tax system kind of came about during the progressive era of the late 19th, early 20th century, because we started to have a couple of different influences. First of all, we started having a more industrial, standardized, and monetized economy by the early 20th century was primarily focused on the use of currency rather than other types of whether it be commodities or precious metals. Most of us transacted in currency. Some of it currency was backed by gold, but it was still currency. And as a result, there became more stable and standardized means to facilitate the collection of revenue. And so government started developing various structures to be able to generate revenue, because at the same time as we modernized and developed the society that kind of has transitioned to what we have today, there was the reality that we would need to implement some degree of enhanced services. So we worked in that direction, and we started, the first taxes were a combination of taxes on goods and services, also known as sales tax in this country. And at the state, and these of course were primarily developed initially at the local and state levels and then evolved to the federal level. But the key development that occurred in taxes by the early 1900s was the development of the income tax, the idea that we would tax income. It was made constitutional by amendment in the 1910s, and it became the primary means by which the federal government collects revenue. It's the primary. If you look at the way that the federal government collects revenue, it's their primary means of generating that. It's a sizable share is collected through income tax. And there are really three different types of income tax. There's the personal individual income tax, there's the corporate income tax, and then a third one that doesn't get talked about as much directly in this book is the payroll tax. What does payroll tax go for?
Payroll tax is the taxes that employers pay to the government for like unemployment, their Medicaid and Social Security, things like that.
Well, that's generally correct. First of all, employees and employers both pay it. It's split half and half between employees and employers. Some of the money, most of that money goes to Social Security, which does cover unemployment. It also goes to cover Medicare. It actually, Medicaid is actually not, if I remember correctly, Medicaid is actually not paid through, is not funded through payroll tax. It's not it is an entitlement, but it is not funded through payroll taxes, but Medicare is. Excuse me for that. So it's, but that's the payroll tax, and obviously, and that is an income tax that just about everybody pays. If you are employed, whether you're self-employed or you're employed by another institution or organization, you pay payroll tax. Even if you net out and don't pay income taxes. Younger people don't pay the individual income tax. They still pay payroll tax. And there are, of course, some tools that we've used to try to refund some of that payroll tax. Probably most familiar that some of y'all know of is the earned income tax credit. But the reality is that that's the most common one, and it's the most utilized. And the charts that Dr. Mike Stell provides in his textbook, even though they're a little dated, kind of provide you an idea of just how significant that is. We also have income tax at the state level, and we'll talk a little bit more about that because it is different. It's structured differently and functions differently than the federal income tax. And of course, also at the state level and at the local level in North Carolina, we have sales tax, which is, of course, taxes on goods and services. And then we also have at the local level property taxes. So those are some key differentiations to look at. But when we focus on taxation, there's some particular characteristics that we look at. The first one is equity. And equity, when we're looking at from a standpoint of taxation in terms of and this is for evaluating different types of taxation, we look at it from two perspectives. So the first is that we look at it from the perspective of horizontal equity, or from left to right. And that really is trying to see that the taxes match up with respect to the benefits that are received. And a lot of times, that's the idea of, are you capturing, is the money that's being paid going to is the tax relevant to what the public receives in terms of goods and services? In most cases, that is generally correct. There are a couple of cases where it may not be. What's an example where you could think that perhaps a tax would not, based on your experience with taxes, where you would not have horizontal equity?
I mean, I'm just thinking about a lot of like social programs that are meant to like alleviate poverty or unemployment. I mean, how can you expect people who are unemployed or living in poverty to be able to pay the bulk of the services that are meant to, get them out of those situations?
That's true, and that's why a lot of times these are sold as insurance programs. The taxes are basically like paying an insurance premium. You hope not to use it, just like you would with any other kind of insurance premium. But the idea being that it is there in case you need it. And for example, that's why with Social Security, there's actually a cap on how much Social Security tax you pay based on income. And that level has gone up significantly the last couple of years. But only a couple of years ago, if you made less than, I think, if you made more than $96,000, you did not pay any additional Social Security tax on any dollars over 96,000. Now, your benefits were restricted to that level. It wasn't going to continue to advance your benefit based on the amount of money you make. But it was that idea that, again, it was creating this insurance or a safety net that would be available to anybody based on eligibility, whether it be by age or by other factors. Darlie gives a good example with the gas tax. Darlie, you want to opine on that? Okay, Darlie, that's okay. So what I will say, and Jillian, I think you also were kind of tying it into road tax. It is possible for people who pay the gas tax to not necessarily benefit from for that to not necessarily have proper horizontal distribution. And that's especially true because even though originally the gas tax was put in place to fund for surface transportation improvements that were used by automobiles, whether they be whether they be roads or bridges or highway systems or whatever the case may be. As our concepts of what the government should provide in transportation have evolved and changed, we now cover a lot of different transportation means through the gas tax or road tax. We cover public transportation. Public transportation, for most places, only this would be the case, and pretty much everywhere in North Carolina, is heavily subsidized by the federal government, and there's some subsidy from the state government. Those funds come from from gasoline taxes. There's also pedestrian improvements like sidewalks or bike lanes. So somebody could argue, I don't, but somebody could argue that if the money is not going for its original intended purpose of road construction, and it's being paid for by the consumption necessary to use the roads, there's a lack of horizontal equity. Jillian, you want to add anything to that?
Now, I was just thinking about people who don't drive, or or kind of like kids people who don't have children who pay for schools. Just thinking about those.
Yeah,
things.
that's true too, and that gets to the public goods argument. And we could even argue, like going back to cars, people who have one of the challenges we're having right now dealing with the electric vehicles is that electric vehicles don't use gasoline. There is retail sales tax on electricity that's purchased to charge your vehicle, but that revenue is not designated for road construction. It's not used for highway purposes. So that's a gap that's there that needs to be addressed.
Professor Hunter, can you hear me now?
Yes, I
Okay.
can.
Okay.
Was there
finally
any,
got
was
the
there
audio.
was there any good? Was there anything you wanted to add?
No, I agree to what you were saying about the gas tax, but I was going to ask the question also, is that also applied to the bonds that we pay for like schools?
Yeah, you could say that too. I mean, obviously, when it comes to some services like schools or parks or special purpose facilities, that's oftentimes an argument that's made is, why do we pay for certain things that we don't necessarily use? And it gets back to something that we talk about a lot. And I imagine if you haven't taken policy analysis yet, you'll cover this in policy analysis, but it still applies even in our previous discussions, is that there are these ideas of public goods, and that while we may not necessarily use them directly, there is the indirect benefit or the direct benefit we have from a society providing the service. That would be the other side of the argument. Obviously, in several of the growing areas of the state where there's a tremendous amount of school construction, obviously that puts a burden on everybody through the uses of property taxes or some other tax mechanisms. And so it can be felt like that equity doesn't exist. And to some degree, in those cases, it doesn't. It may exist from an operational perspective. You want the kids to learn, but in terms of the added cost of building out facilities and operating those facilities, that can be a challenge. Yes, LK Alexa 2. Person who has their hand up.
I'm sorry, I was muted, didn't realize it.
Okay.
Linda Alexander.
Lynn, thank you.
That's kind of like the same concept. I'm thinking, even as students at UNCG, you pay tuition and fees. So the
Mhm.
would be like paying those taxes that we're talking about, right? Would that be like a horizontal tax?
That would be true. That you can argue about the challenges. I mean, obviously, and we'll talk about user fees next week, but you make a good point that a lot, particularly for graduate students and for non-traditional students and for students who participate online, a lot of the fee structures that universities have are for services that they don't necessarily take advantage of.
Mhm.
Like a lot of schools charge a fee for the financing of dormitories or whatever the case may be. in addition to charging rent and stuff like that, or for fitness centers or those types of things. And you as a student are paying for them whether you want to or not. And so that becomes an additional cost. And that's an example where there's a gap in horizontal equity. Let me read this text this message just came in from Trudell. We discussed a scenario where constituents were voting on a school bond referendum. There was a divide between parents within a school district versus other adults without children in the same district who may not want their taxes to go towards school construction. And that's a common issue. My wife's late grandfather lived in Wake County, lived in Raleigh, and he was a very progressive minded individual, but at the same time, as he got older and saw how much his property values were going up and the fact that the taxes were not going proportionally down, was not terribly thrilled about the additional money he was spending on school bond issues. So that can definitely be a challenge. And that's another example. Yes, students can attend every sport game for free, but there's no guarantee that they're going to. And if UNCG is like where I went for undergrad, Tennessee Tech, I doubt too many students attend every game, particularly for some of the sports. I'm glad, though, that they provide that. That was not something that they provided at Georgia. You had to pay to go to games at Georgia. But of course, it's a little different environment there. But I didn't attend any games at Georgia while I was there as a student. Let's now transition into vertical equity. And of the two types of equity, this is the one that gets the most focus a lot of times. And this deals with the ability to pay. And really it talks about, are you dealing with the distribution of taxes and revenues on the basis of a person's ability to pay them? There is a lot of debate about this, particularly with the primary means of taxation that we use in this country. And we typically look at it from three different perspectives. That a tax from a vertical equity perspective is either regressive, proportional, or progressive. So what is the definition of regressive vertical equity? What does that mean?
If the rate decreases as the ability to pay increases?
Correct. So it's an inverse relationship in that the amount you pay as a share of your income or share of your wealth or share of whatever is being considered for economic purposes as your ability to pay, that share decreases as your income or your wealth increases. So what would be a justification for saying that taxes should be regressive? It seems a little counterintuitive, but okay,
Is it
Carolyn, go
like
ahead.
an incentive structure, like you're incentivizing people to earn more or work harder, because if they do, they'll get to keep more of their money?
That's one way of looking at it, yes. What's another argument that can be made?
Like when with your vehicles as they age and get older, your properties and vehicles as they age and get older, your taxes should go down. You should be paying less.
Right, that's a good example. Obviously with vehicle valuation, or in the cases of some other depreciable asset, you may pay a lot to begin with, but you'll pay less as the vehicle ages. If you're somebody who holds on to vehicles like I do for 15 years, it works out to your advantage. But another thing to think about is there are some who argue that just because you're paying more in taxes does not necessarily mean that you get more in terms of value in the services you receive from government. Now, that doesn't necessarily always balance out with the argument about the ability to pay, but it is something that is brought up a lot by people to say there's only so much that I can consume. My my share doesn't necessarily change despite whatever my wealth is or whatever my income is. Anybody else have anything they'd like to add?
Wait, I'm just so this is, I guess, clear. So you think this regressive taxing, like it fits better under a horizontal idea
No, this we're
of
dealing,
tax
we're dealing,
equity?
no, we're looking purely vertical.
Okay. I
Taxes,
thought the argument was that like your use of the service doesn't really go up as you get more income. And in fact, it's kind of intuitive that the lower your income is, the more you would be using the services. And I guess under the horizontal argument, you would be paying more for them, or am I misunderstanding what you meant?
no, you're right about that. So all taxes have some position of value in horizontal equity and have some position of value in vertical equity. So they each have characteristics in both. And so you do make a good point that if the horizontal equity of a service or good is limited based on taxation, that it could make sense that then it could balance better with a regressive tax in the minds of some people. That's not always the case, but it does happen. So that's a good point. Now, what do we mean by proportional? What do we mean by proportional equity?
Just that the rate stays the same as like your ability to pay, that there's like a constant relationship between the two?
That there's a constant relationship, yes. So in the purest form, a flat income tax would be an example of a proportional of a tax having proportional vertical equity, because that tax would be set at a certain rate, say 5%, and you would pay 5% of your income, whether you had $1 or you had $1 million. And yes, John, you're absolutely correct. It does kind of get at the idea of flat egalitarianism. You want to extend on that a little bit?
I mean, certainly. It's sort of rooted in like a classical liberalism, classical political liberalism, and this idea, sort of like what you were saying, like, oh, this flat tax is equality in the strictest of sense. Everybody doing the same exact thing.
Right. And as we know from the broader study of equity, it fails to recognize other factors. So
That's
now
right.
we come So now we come to progressivity, which obviously is the opposite of regressive, and it is the direct relationship between ability to pay and cost. And that is that the rate of taxation would increase as your ability to pay does. And obviously, our federal income tax system is the most prime example of that. Taking out, and for this case, I have to separate out the payroll tax. The payroll tax is a separate tax, even though it is paid by everyone. If you look at the income tax, it is designed, not saying it's necessarily administrated or applied this way. I know that there's a lot of things about the income tax that we'll get into, but the design of the income tax is that the more money you make, the higher rate you pay. That is how this thing is structured or designed to be structured. And so the goal is that would be an example of progressive tax. Many state income taxes are effectively progressive in their actual application because they're very limited in terms of other things that can be done with deductions and exemptions and other factors, and of course they have lower rates, but they are more effectively progressive. California and New York are good examples of that. So I hope this gives an idea. Are there any questions with respect to this discussion on equity? Yes, Jacqueline.
I was thinking about the flat egalitarianism, and it made me think about like something that might be considered even more flatly egalitarian, which would be just like an amount, like everybody pays the same amount. And I was wondering if that's a thing or
There
or
are
if that's-
people who have advocated for that. There are some people that believe that's why certain, and we'll get into this when we talk about goods and services, why certain necessity goods should be taxed. And this is a very small group of people. You can probably get them all into one room nationwide. But they this is the idea being that the broader, that if you tax good, that there are theoretically ways of doing it. You could just set, I mean, there were times in our history where there have been those types of taxes, or sometimes those flat amounts, and we get into fees. That's a common example with respect to fees. You pay a flat amount, like if you're using a city parking deck, you pay $5 to use the parking deck. Doesn't matter how well you can afford to use it. Doesn't matter what kind of car you're driving. You're still paying $5, and that gives you the right to use that parking space for the day. You know, that's an example of a flat. That's the example of a flat, and the reason why is because regardless of the size of your vehicle, regardless of who you are, it's been determined from a financial perspective in terms of building that parking deck that it costs a certain amount of money. That if say 80% of the deck was full over the course of 7 days a week, they figure out this is the amount of money we need to raise, and this is the number of spaces that are going to be filled. So we're just going to divide it by this and figure that out. So that's really the challenge there. So it is applied in some cases, and that's where fees come in. But from a standpoint of taxation, it's relative. It's not been used as a means of generating revenue. And I want to be clear about that, because there was a time in our history where we did have that type of tax, but it was not used for generating revenue. It was used to prevent voting, and that would be the poll tax. So that's not, toll taxes were not used to raise revenue. Poll taxes were used to disenfranchise people. So I want to be clear about that. So let's go now to some other examples of, and let me look at this comment here. Hold on just 1 second. From Cole. Cole, we'll get into that a little bit later, but thank you for the question. I want to go ahead and move to the next one. Syntax we'll cover, Tredell, we'll cover syntax here when we get to goods and services, but definitely need to cover that. So if I don't get to it, will remind me when we get to that discussion. So let's talk about from the situation, and this is covered in the text, from a situation from impact to incidence. So taxes have an initial impact on a given party. And this is especially true, but there's the possibility that the actual tax itself, even though it may be assessed on one party, may not be actually paid by that party. It may be passed along. This has oftentimes been used to argue against corporate taxation, which is a form of income taxation, or against other types of various fees or charges. For example, after the September 11th attack, the federal government came to the airlines and the airports and said, we're going to nationalize airport security, and this is going to be a very expensive operation. And so they said, we need to assess taxes to pay for it. And since it's being done on the basis of air travel, we want to assess it on air travel. And the airlines and the airports said, okay, but we understand, but what really matters is how you do it. And so what they did was they actually they actually applied the impact and incidence to the passenger. So that's why you pay a fee on top of your ticket. The airlines did not want to pass that tax on to you indirectly. What they wanted to do instead was simply say, you pay it. And so what happened so that you pay that directly. It's kind of related to this concept known as forward shifting, which is where the party that incurs the tax, that incurs the direct impact of the tax, applies the incidence and shifts the incidence forward to another party. And a lot of times it's the argument again made against corporate taxation, that if corporations pay taxes, that a lot of times they would then have to pass that tax cost on to consumers of their products or services. Some do, some don't. Taxes can also be shifted backward in terms of that a tax can be reversed. And then there's also the times that businesses or parties will absorb the tax. This happens a lot as well. So so when it comes from input to incidence, let me look at the example real quick. Give me just a second. The chart is on page 377 of your text. And what happens is that, the business is taking on the impact of the tax in this case, whether it be through some kind of income tax or some kind of privilege fee, which we don't have in North Carolina anymore, or some kind of taxation. And they have three options in terms of how they forward it. One option is to shift it forward which results in a higher price the customer pays. They can absorb it, which means they simply it eats into their profit margin, or they can shift it backward in that they can make their supplier or the resources they use to provide certain products or services take a lower rate. Let me read. Give me just a second. Let me read this. From John, many merely eat the tax with the cost of having slightly less profit, but many would rather pass on the tax for political gains purposes. The rather framed debate. That's absolutely true as well. And and I think a lot of times when we talk about these types of taxes, we have to look at different types of businesses. I would say definitely when it comes to corporate taxes, they're already, when you're talking about major corporations, as we know from examples, they're already figuring out ways to avoid paying taxes and do a very good job at it. A lot of times the challenges with smaller businesses and such, and the challenges that they play. But you're absolutely right. There are a lot of cases where taxes are absorbed by the person who takes the impact. We also then have this concept of economic impact as well. And there's a good example. There's a good discussion about this in the example. I believe it's on the economic effects that we'll get to, sidebar 8.2 on 386, which looks into these two different factors in terms of economic impact. The direct impact is through the tax burden, which is the payment that's made by the taxpayer to the government. And think of it from this perspective. You are paying for a service you receive, and it is possible for that to potentially create economic benefit, like education creates economic benefit. But that's not always necessarily the case. It's kind of a sunk cost. What happens is you have the impact of the tax burden, plus there's the potential for excess burden, also known as deadweight loss or welfare loss, which together these create a challenge known as economic distortion that can be caused by a tax. There are cases, for example, during the early days of the Clinton administration, they were really trying to focus on rate. They wanted to find ways to raise taxes in a progressive fashion. Cedric, that's a good example. Under economic impact, opportunity zones definitely, and opportunity zones is a wild one from the standpoint of how that was structured, because it was designed as a way to. We'll get into that a little bit when we talk about income taxes, but it was designed obviously to avoid taxes on capital gains. So, it's very interesting concept. But the tax burden and the excess burden together create this impact. And I'll give you one example. In the early 1990s, during the Clinton administration, they were trying to find ways to apply progressive taxation or find ways to tax people who had more ability to pay. So one of the things they decided to do was implement what was known as a luxury tax. And they basically picked out certain types of products or services that wealthier people used, and decided to say that they were going to assess consumption-based taxes on these goods. And the most common example that was given were boats and yachts. So if you, like they said, if you buy a boat over a certain value, you have to pay this luxury tax. You could still, it still allowed it to where the average person could, if the average person wanted a bass boat, they could still get a bass boat or a pontoon boat. But what they were really trying to do is really trying to go after the higher end consumption. Well, that created this excess burden, because what happened was a lot of people who wanted these items just decided we're not going to buy them. So it resulted in some economic decline for some select portions of North Carolina, of the country, including along North Carolina coast, where you do have some boat building operations that do make some higher end boats. And it did create a sense of economic distortion. That was not the intention of it. The intention, they thought, was that people would actually just pay the tax. Well, it turned out that's not exactly what happened in all cases. It was the impact was probably oversold by, obviously, by tax opponents, but still at the same time, it did have some effect. Two other factors to look at. We talk a lot about collectability. Again, this gets back to tax administration and the ability to collect taxes. This is, of course, the concern that has come about due to the rise of cryptocurrencies, which I am not an expert on. I don't try to be an expert on that. But the fact is that you are creating value in a form, in some kind of currency medium that allows you to accumulate wealth and actually accumulate value as a traded commodity, as a traded currency, that has the potential that you could actually, that if you are engaged in transactions directly with someone using crypto, you would not currently, there is not a tax system out there to really be able to apply to it. Now, if you're buying cryptocurrency on an exchange like crypto.com, and you're buying and selling it that way, it will be captured as a capital gain, and you will have to pay taxes on it. But if you're buying the crypto, let's say you bought the crypto from somebody for $100 and you use it to buy, say, $200 worth of product from somebody paying directly in crypto, there's a $100 increase in value that's not being taxed. And that's part of the challenge. It's still, compared to the overall share of the economy, it's still limited in use, but obviously there's a lot of people who've made some money. There's a good number of people, not a lot, but a good number of people who've made some money on it, not as much recently, but over the past 2 years, that are dealing with, that are seeing that value, and they're not necessarily incurring taxes as a result of it. So that is something that the government looks at. There's a chart that talks about tax administration costs. I believe it's on page, let's see here, page 392, talking about different types of taxation. And generally what you see is that the costs are fairly limited in a lot of ways. For income taxes, sales taxes can be higher depending on the type of tax, on the way sales tax administrator talks about here in North Carolina, based on this estimate, that for every dollar in sales tax that's collected in North Carolina, 0.7 of 1 cent would go towards the administration. That's honestly not a bad amount of money to lose in that. You're still getting over 99 cents out of every dollar that's going to taxation, but you have to factor it in there. And of course, one of the things that was talked about recently is that the federal government is trying to improve its tax collection, which of course increases administration costs. I will tell you that one area that I've been concerned about, and this may affect some of you, has been the fact that I can see where they are going to be more, they're going to apply more enforcement on those individuals that are working in gig economy jobs. Because depending upon how your employer handles your payment, if you are a gig worker, and I would assume maybe one or two of you are, that can create some challenges with respect to ensuring compliance. Now, I'm not accusing anybody of not paying taxes. I want to make that clear. What I'm saying is that we know that because of the fact that it requires that you have to handle it differently than if you're being paid on a 1099. Some of you have experience with that, as opposed to being paid through a W-2. That's going to be a challenge. And John's absolutely right. Enforcement, no one ever gets the good end of enforcement, especially true when it comes to taxes. So that's something to keep in mind. And then the last item we look at is with respect to transparency. So when we look at transparency, we're really looking at, first of all, how was it adopted? Was it adopted in a transparent fashion through the legislative process? There's been some concern that there are certain types of taxes or fees that basically act as taxes that were instituted through regulatory action through administrative law. And so that obviously creates a transparency issue from that. There's the administration, making sure that it's that way. Easy understanding of compliance requirements. The amount of the tax burden, understanding what your individual burden is, regardless of the equity question, being able to understand that burden. Those are important. All of those are important examples. So I want to go back before we go on and answer the sin tax question. A sin tax is kind of like a tax on goods and services. It's intended, it's politically sold for one reason, but it really applies in a different reason. Obviously, the political argument made about sin taxes, whether they be for alcohol, tobacco, and of course now more discussed, even though it's still not legal in North Carolina, cannabis, is that you are taxing a product that is known to have a potential negative effect on society through its consumption or use. With alcohol, people drink. There's the possibility of drinking, of drunk driving. There's additional cost to law enforcement and to public safety, as well as the risk it imposes to other people. There's the possibility of how alcohol affects families and other factors. So this is how it's sold. And the idea, if it was being done in a way to facilitate horizontal equity, would be that the money that is collected from the sin tax would be applied towards those programs and services that you need to have to offset the negative social or negative societal effects created by the activity. However, what I will tell you from experience is that that's rarely the case. There were some efforts with cigarette taxes as they went up. The argument was made with the more recent increases in cigarette taxes, that's to help pay for the Medicaid share of costs associated with tobacco-related illnesses. And in some places, they can make that argument when you put the numbers together, but they don't necessarily add up. And obviously, as we get into the issues of products that will probably be becoming legal in North Carolina, whether it be cannabis or sports gambling, there will be, of course, pressure to put taxes on those. The argument will be made that that fund should go to whether it be recovery programs or go to other types of programs that are designed to alleviate the negative impacts of these so-called vices. But the reality is that it's mainly a money grab, that you're just simply trying to gain additional revenue by taxing a new product that's become legal, a previously illegal product that's now become legal. So it's mainly about revenue capture. Does that answer your question, Trudell?
Yes, it does. Thank you.
Okay, good. So we finished up with the conversations with respect to Chapter 8 on taxation. Are there any other questions in general? We'll get into the major tax structures here in just a second, but I just want to see if there are any questions based on what we've covered so far from Chapter 8.
Yeah, could you go over just one more time, the difference between tax burden and excess burden? Is excess burden just like a more societal or social version of tax burden being like an individual thing? Like, is it just a matter of scale, or?
So when we look at excess burden, and I'll go back to the example from before, and I pulled this from page 386. Second sentence, there are the tax burden, which is the payment. The tax burden is basically whatever it costs you to pay the tax. The excess burden really is the overall cost of paying that tax. So for example, in economic theory, there's this idea of the multiplier effect when money is available in the system, when money is being spent in the economy. And I'll go back to that luxury tax example with boats. Somebody goes and spends $1 million on a boat. Well, what are they getting? Well, what they're really getting is they're getting $1 million worth of parts, labor, and profit from another business, which means you're creating income for the people that work on it. You're facilitating the transaction of goods and services. If a tax precludes that purchase, i.e. I think the tax was 30%, if I remember correctly, over a certain amount. If the tax basically prevents someone from buying that boat, they would only be paying the basic tax. But what the real effect is on the boat builder, who then doesn't build the boat. Now the boat builder may be in a position to build smaller boats, and some boat builders were able to transition to that. And John put it here in the text, and what the multiplier effect is, the equation. But for general purposes, the excess burden is understanding how the tax creates a distortion in the economy.
Okay, and that's kind of like the unintentional example of the boat tax, and also like another example is that like the feds putting the brakes on the economy when they're trying to make sure it doesn't overheat, kind of purposefully taxing people more so they can kind of lower inflation. Is that kind of the same thing?
So there have been times where that happened. It happened in the 1960s and 70s. We had a surtax that was done specific. That part of the reason why the surtax was done. One, it was done to raise additional money because we needed it, because we were trying to fight in Vietnam and build the Great Society. But it was also done because we started having this rapid rise in inflation, particularly after we went off the gold standard. And so one of the ideas, along with other mechanisms that the Fed has, including raising interest rates or reducing the money supply by requiring banks to hold more money in reserve, taxes can be used and have been used from time to time as a means of curbing inflation. There was another, some of the things that happened in the early 80s during the Reagan years was a combination of that too, because Reagan actually did implement tax cuts in 1982 with Congress, and they were focused, and there were some additional tax changes made in the mid 80s during the Reagan years. But some of those tax changes were done along with significant raises in interest rates and reduction in the money supply to try to reduce inflation. Obviously, that does have a withdrawing effect on economic growth. And that's the reason why we suffered a recession in 1982, a brief one, but still suffered a recession then. That really, as my macro teacher in college would talk about, he said, at that point, Reagan became a Keynesian. But the fact is that there are many tools, but there are some people who like to look at interest rates and inflation as forms of taxation. I don't, because it's inflation can be driven by factors outside the control of government. There are times when the government could be argued that it is facilitating the growth of inflation. But there are a lot of times where inflation occurs for things that are outside the government's control. So I don't necessarily agree with the idea of referring to inflation as a form of taxation, even though it has a similar effect to taxation from the standpoint that it reduces the amount of money that somebody has and doesn't necessarily produce an equivalent benefit. Anybody else? Okay. So let's now go. So what I've done for chapters 9, 10, and 11 is, and I knew that this was going to be I wanted to make sure, is I wanted to have some discussion with respect to these major tax structures. So I didn't pull out slides. I'm just going to go off script here, but I strongly encourage y'all to participate. So we talked about how, first of all, let's look at income taxes. And the text in chapter 9 goes into a lot of background about it. You learn a lot about it. First of all, show of hands, how many of y'all prepare your own tax returns? You can use the hand shaker. You can use the hand feature. I imagine most of y'all do. I do as well. And so y'all are familiar with using tax software or filling out the forms directly. I did that for a long time. Only a couple of years ago, I started using TurboTax. And that, of course, it's a practice that we go through every year. But we don't necessarily pay our taxes on April 15th. We're paying those taxes throughout the year. Right prior to the Second World War, we decided to, at the federal level, implemented this concept of withholding. So instead of you paying your taxes directly to the federal government, we basically the government went to your employer and said, you need to withhold this money and go ahead and bring it to us. And obviously that helped with the administration of taxes, because dealing with businesses, there's a smaller number of businesses than there are with people, so it ensured greater compliance. It also provided more direct funding at a given time. The government wasn't sitting there having to wait for the money to come in. They could receive it on a more regular basis. If you happen to be a small business owner, of course, you're still responsible for paying your taxes throughout the year. You pay it on a quarterly basis. So any income that you make, like say off the 1099, goes in as you have to pay that on a quarterly basis. So that's typically how we pay it. And then of course we fill out the tax return and we turn it in by April 15th. And there may be some additional taxes we have to pay. If that's the case, we actually have to pay that plus a small amount of interest, because technically the taxes were due on December 31st. But if not, we receive a refund, which is just important to remember. If you do receive a refund, there's nothing wrong with a refund. I get refunds and I'm happy for them. Just remember, there's no interest paid on the refund. So that's based on the actual amount of money that you paid, that you overpaid in taxes in the prior year. So you're not getting any interest built up with that. The government's not paying you interest, but the government expects you to pay interest when it comes to paying late taxes or back taxes. So that's just something to keep in mind. So
And they don't waive those interest fees.
no, they don't. They don't. You're absolutely right about that. So when it comes to income, as we talked about, the federal example is designed to be progressive, but what are some of the elements to the federal tax system that perhaps limit its ability to be progressive?
Is it the tax loopholes?
Right. It's the elements of the regulation that is put in there that that of course is done by legislation that enables various deductions and exemptions.
Another limitation.
Sorry, go ahead.
I said another limitation are the people who donate to the politicians who write the tax code.
Right. They're the ones who make it happen. And in reality, that's a bipartisan problem. So it's there's definitely a lot of maneuvering that goes on in tax law. If you know a tax accountant, of course, right now, this is their busiest time of the year because they're working through all of this. The challenge they've had for the last several years is that these tax laws are typically written late in the calendar year and adopted late in the calendar year. And in fact, in a lot of cases, don't get published by the IRS or by the US government until after the beginning of the next calendar year. So they have a very brief period of time to look at those laws and make sure that they apply them appropriately when working on returns for various individuals and businesses that use accounting services. But the reality, of course, is that the system itself encourages everybody to pay the lowest amount of tax that they are legally responsible for. Very, very, very few people. I'm thinking back to that example from the Simpsons episode where Ned Flanders is filling out his taxes. Very, very, very few people purposely pay more than what they're supposed to. Everybody is trying to pay the least amount that they are legally responsible for. And that's perfectly okay given the rules of the system. However, what that means through deductions, through exemptions, through other tools, including the notorious loopholes, is that you can effectively reduce your tax rate very well. And of course, there's been a lot of examples given over the years. You know, the one that most people probably have heard of is the example of Warren Buffett, who of course is a very well-known investor, very rich man, who effectively talks about how the amount of income that he pays in taxes every year as a share of his income is less than his secretary. And the reason why is because the tax code is written in a way to facilitate him being able to take these various deductions and exemptions with the belief, and this is the political belief, not always the actual application, but with the political belief or political understanding that these exemptions and deductions will help increase economic activity as well as prevent economic distortion that would otherwise happen at the given rates. You can argue that multiple ways, and that's definitely the case. Brantley also makes a point there. The government only has so much money because it is funded through direct appropriations through Congress to be able to enforce the tax code. So they only got so much money and so many people to be able to do the work, which also creates a problem. That can be a challenge as well. So theoretically, yes, the federal income tax system is designed to be progressive, but as we see with its application and the way that it's administered, it could be argued that in application, it's actually a regressive tax system, And there's certainly some very strong examples of that. Now let's take a look at North Carolina's tax system. North Carolina, when I first moved here 16 years ago, had a progressive rate system. Based on your income, you paid a certain rate, and that rate went up at the levels of income that you earned. And in 2011, they actually modified it and transitioned to a flat rate system. They reduced the number of deductions. They tried to simplify the tax system here in North Carolina for individual use. Theoretically, that makes it a proportional tax structure. However, there are still deductions that are put in there, and especially there are individual deductions and exemptions similar to the federal tax system that are put there on your first so much money of income. So in theory, it is slightly progressive because obviously it's not capturing all income earners. It's not designed to capture very low income earners. And then it does trickle up a little bit, but it is primarily proportional. And again, that's how it's sold, and that's the theoretical application. At the same time, the tax system in North Carolina has a variety of exemptions and deductions. That of course can mean that you don't that those at higher income levels end up actually paying less of a share of their income, and as such, and it ends up becoming regressive. So, can somebody describe to me what the difference is between a tax deduction and a tax credit?
I think that a tax credit would be like you mentioned earlier, like the child care credit,
Mm-hmm.
be a tax credit, right?
Right.
And
So, I'm sorry, go ahead.
no, because I was getting ready to guess at this. I think that a tax deduction would more be along the lines of what we have to pay, like whatever taxes that we have to pay. So a tax credit is actually giving you something, and a tax deduction is taken away. Is that right?
Correct. And so that's a good way of putting it. So like going back even to, so there are deductions that you can take that reduce your tax liability. You can take, there's what's called the personal deduction, there's the dependent deduction, and those deductions you go ahead and calculate on your taxes, and that reduces the taxable income that you have, so that of course that taxable income is what the tax rate is then calculated against. Tax credits, on the other hand, is where the government actually is directly reducing the amount of taxes you pay by basically forwarding it. And the child care credit that was implemented this past year, which provided for and this was a case where it was actually advanced to individuals with children, to where they actually received money from the government. Whenever the government gives a stimulus or any type of payment like that, it is treated as a tax credit. So for example, when you received money during the COVID pandemic, those were tax credits. They went ahead and gave you the money in advance, and then on your tax return, you would indicate that you don't owe the tax because you're paying it. They would just reverse it. The same is true with the child care tax credit. Now, the child care tax credit, if I remember correctly, was voluntary. You had to choose whether or not to receive it. We only have one child, so we made the decision not to receive the child tax credit in advance. We'll just write it out. We'll take it as a credit on our taxes when we file here in a couple of weeks. So you can, that's the case of the situation. And I think John puts it here with reduction or deduction, you don't pay what you owe, but a credit is like a bonus. And that's a good way of looking at it. And tax credits have been around for a long period of time. We typically hear about them either from an individual perspective, or sometimes we hear about them from a corporate perspective when they're used to incentivize economic development or do other activities. But there's definitely some different options out there for that. Are there any questions that anybody has with respect to income taxes? Okay. So now let's talk about taxes on goods and services. And we've, of course, had taxes on goods and services a lot longer than we've had them on income. And typically the way that we think about it here in the United States is through what's known as the sales tax, which was, as I talked about before, was developed, kind of dates back to, it primarily dates back to the 19th century, but it became very popular during the 20th century. Originally, these taxes, like most taxes, were low rate, and then they were very broadly based on as much activity as could be taxed. And that idea was, to some extent, to make them as proportional as possible, so that as you transitioned in your lifestyle based on the amount of money you had, you didn't necessarily avoid taxation. However, one of the biggest challenges came about in the mid to late 20th century as for people with higher incomes started shifting their buying from goods to services. And that's when we started seeing this issue of regressivity that we see with the sales tax, particularly in the fact that most sales taxes originally were applied at the same rate as they were applied to everything else on groceries or other types of basic necessities. And so as a result, somebody who had less disposable income was paying a higher tax rate because they were basically spending all their money on necessities, whereas somebody who had more money wasn't paying that tax on services, and as such it became regressive. So here in North Carolina and in other states, particularly over the last 10-15 years, measures have been taken to broaden sales tax bases to encompass more services. That was a major change that occurred about the same time as flattening the tax. There are also some challenges with respect to the sales tax when it comes to administration. And we saw this in particular with the legality of sales tax and online sales. Originally, the thought was that sales taxes, since they're a state-based tax, that could only be applied on transactions that occurred within a given state. So I'll give you a personal example. It used to be, and this was near 20 years ago, it's 20 years ago this spring. So 20 years ago this spring, I bought my wife's engagement ring. And I bought it, we were living in Georgia, so I bought it from a jeweler in Atlanta. What I did, however, was I actually had the ring shipped, mailed, and paid for through my grandparents in Tennessee. Now, I paid for it, but I paid it through them. And the reason I did that was that at that time, it was perfectly legal to buy it as an interstate transaction and avoid sales tax. So it was not illegal. There was nothing technically wrong with it, but it did result in a loss of money to the state of Georgia from the sake of the transaction. So the ring was shipped to Tennessee. I proposed to my wife in Tennessee, and that's how it happened. However, this was before the rise of online sales. This was back in 2002. Amazon was still almost entirely only selling books at that point. And Amazon challenged the idea, really changed it, because Amazon and other companies like Wayfair, Overstock, and others created this market which began to erode the physical or brick or mortar business market in terms of the transaction of goods. So this was a direct effect where the way in which we bought goods, not dealing with services, but the way in which we were buying goods was changing such that the taxes could not keep up with it. So over time, these online retailers were taken to court. And eventually the courts, about 5 years ago, I believe, actually ruled in favor of the states in saying that because that even if there's not a physical location of that business in a given state, i.e. a distribution center or a warehouse or something like that, you still have the means to, it's still technically being consumed in that state, still being used in that state, still the purchase itself takes place in that state because you're buying it for yourself and consuming it. So they began to kind of broaden it to not just the purchase, but also the consumption of taxes, consumption of assets. And so as a result, the online retailers lost. But in reality, they didn't, because what they did was that they were already starting to shift to faster delivery, which meant they basically had to now have physical presences in all 50 states. So all it did was really buy them time to not have to charge taxes. Of course, now most online retailers charge taxes, but it really has not done anything to affect their market position. It's only continued to grow, and it blew up, especially during COVID. So the reality is that now what's happened is that states have seen this massive increase in sales tax revenue from these services like Amazon, and it's also so that has helped generate additional revenue because that revenue was being lost. And what was being found is that while there are a lot of people who buy essentials through online services, there's a lot of additional non-essential purchases that take place over these sites for a variety of reasons, and that there was actually a growth in consumer activity. Now, you can argue that there might be some economic downsides to people buying more one way or the other, but it's still something that we have to keep in mind. But now when we look at sales, I'll be very honest, if it wasn't for online, the ability to tax online sales, the challenges that local governments state and local governments would be facing, including North Carolina, as a result of the COVID pandemic would be significant. Because what happened during the pandemic was that we lost our service industry because the service industry in a lot of ways was locked down as a result of mitigation policy. So we have this change that has occurred. But at the same time, this doesn't change the fact that generally speaking, when you look at the research, that sales taxes, like these types of consumption taxes, are seen as regressive. So what are some examples of some other types of good and services tax?
Hotel taxes, occupancy.
Yes, the occupancy tax. From a horizontal equity, again, this is kind of seen, this can be, it's the occupancy tax is actually attempted to be a proportional tax because obviously there's different levels of hotels. Theoretically, of course, actual application, it can still be construed as regressive. The goal of occupancy taxes, at least in North Carolina, which are established at local levels but require state legislation to become active, is that these taxes fund, for the most part, services and activities associated with tourism. So the money from these taxes is going to tourism activity. That's a good one. What's another one?
E911.
Right, E911 is definitely one. It's a flat fee. Trying to remember. I think part of it's a percentage and part of it's a flat fee. That money is directly distributed. Again, very strong horizontal equity. It's paid on your phone bill, and it goes out to help fund certain expenses associated with E911 call centers. It has suffered some challenges in terms of its effectiveness because particularly with the loss of landlines, as people have just dropped the landline and our cellular only. That's kind of reduced in the total number of lines, and as such has reduced some of the revenue from that source. What's one more example?
Toll roads.
Toll roads, yes. Toll roads are kind of a cross between a tax and a fee, but there is a tax, but obviously they're mandated, but that is one as well. Okay. Any questions with respect to goods and services taxes? Okay, now we come to property taxes. Property taxes were among the earliest taxes that were established in the country. Property taxes are primarily issued at the local level in the United States. There are some states like Texas and New Hampshire that have state level property taxes. But in most places, including pretty much the entire Southeastern United States, property taxes are local. And they are they're the largest share of local revenue. In the example that I'll show you tonight in the lab, you will see that it's the largest share. The challenge that we have with property taxes is in the administration. So what are some of the variables that they talk about in the book with respect to property taxes? What are some of the ways in which property taxes can be applied differently? So I'll go ahead and talk about the assessment process. And there's been a lot of discussion about the assessment process because there are some questions about the equity in how properties are assessed. Each state has kind of their own approach to assessment in terms of the standards that are used, and it talks about in the book about standards. But one key example of differences can be in the cycle of assessments. So when a property assessment happens, a government official or someone hired from the government who's an assessor will evaluate the property based on its present value at a given time using a variety of factors. Those cycles can vary from anywhere from 1 year, in which case a property is reassessed every year. That's what happens like in major metro areas. It happens a lot in Virginia. The city that I work for in Virginia, Manassas, that's what we did, to longer periods of time. In North Carolina, the standard assessment cycle is 8 years. So once every 8 years, all the properties in a given jurisdiction are assessed and are revalued based on that assessment. And mainly when we are talking about these assessments, what we're talking about here is real property, homes, land, and buildings. Personal property is a little bit different, and I'll talk about that in a second. But the cycle for real property, buildings, homes, and land is 8 years. And so that creates some differences, because if you're only reassessing every 8 years, you can have some significant changes in property values. North Carolina also has a rule that once the assessment gets out of balance by a certain percentage, and I want to say I can't remember exactly, but it's like more than 20%, it actually has to be reassessed. So some places actually have their reassessments kick in early. There are also some jurisdictions like Mecklenburg County that do assessments every 4 years by law. So that helps shrink the time to help reduce the amount of variance between one assessment to the other. Of course, in the current real estate cycle, where prices are appreciating significantly in multiple markets, that's kind of a misnomer. So there are a lot of different ways the assessments can be done. There's a lot of different approaches. And that can create a lot of challenges. There's also the fact that depending on the type of property, its assessment may be valued differently. So in a lot of states, North Carolina is not one of them, but in a lot of states, for example, agricultural property is valued at a certain percentage of its overall value, as assessed at a certain percentage. Homes and building land are assessed at a certain percentage, and businesses are assessed at a different percentage. Here in North Carolina, everything's assessed at 100% of its appropriate value. So that's a more standardized and flat approach to doing it. So there are a lot of challenges. Also, the calculation of the taxes can be different. You have states like us that base it on a rate that's based on $100 of assessed value. You have other states that do the mill, which is the value per $1,000 of assessed value. It gets the same calculation, but they can be done differently. So there's a lot of mechanics with respect to property taxes that have to be factored when developing it. Also, when values are assessed, once that assessed value is calculated, in North Carolina, there is a rule that the jurisdiction that has the reassessment then has to calculate what's known as a revenue neutral rate. That revenue neutral rate is basically allowing the county the jurisdiction, whether it be a city or a county, to collect an equivalent allowed amount of money equivalent to what it collected in the prior year. So let's say you had just doing this roughly, let's say you had a property tax of 20 cents per $100 of assessed value. The assessment overall total value of the total assessed value of property in the jurisdiction went up 5%. They would reduce the revenue neutral rate would be reduced by 5% of 20 cents, which is 1 cent. So it would go down to 19 cents. There's also a lot of conversation that comes about with respect to tax relief. And this is especially going to be a challenge here in North Carolina because we don't really have a lot of tools that the state allows local governments to use to provide relief to property owners. And how can that be a problem? How can that create problems?
Somebody is like living in kind of a place they had bought a long time ago that's like recently gone up a lot in value because it's become more attractive, and either they're on a fixed income or very low income and they have difficulty paying taxes on the property they already own.
Exactly. So that's a very common issue. It happens in a lot of places, even with some of the tools that it's talks about in chapter 11, like circuit breakers or deferrals or exemptions and credits and abatements. But these are challenges that we run into, and there's not really a lot of tools that local governments can legally use in North Carolina to help these people out. So as a result, somebody could, if they're particularly, this is a side effect of gentrification, could find themselves in a situation, could find themselves in a position where, again, they own their house outright. It's clear they're on a fixed income and they could see their property taxes go up 20 to 25% as a result of reassessment. And as such, find themselves in a position where they can no longer afford the taxes. There are other states that have found ways of trying to address this. Very commonly, there are exemptions that are based on longevity in a home or other qualifying characteristics. North Carolina does have one for veterans. There are credit programs. There are abatements. The way a tax abatement works is that, well, abatements work similar to exemptions, but there are abatements. There's also the concept of deferral, which basically allows somebody to defer the taxes on the property until they sell it, and then they can turn around and pay those taxes. That's not a very popular way, but it has been used in some places to facilitate that. There's a lot of different tools that are out there, and I'm hoping that particularly in the next year or two, North Carolina's the state legislature will give North Carolina local governments some more flexibility in being able to apply these tools so that they can help people stay in their home, particularly those who deserve to stay in their homes and have been in there for a long time. So are there any questions with respect to the information on property taxes? What would a land trust designation be considered in tax terms? So a land trust, and there's a couple of different types. A land trust would be valued, if it's a nonprofit land trust, depending on the way the laws are written, you would still value the property, but you wouldn't assess value. So give me example, which one you're talking, what type of land trust you're talking about, Fidel?
So there was a nonprofit that I worked for a few years back called Durham Community Land Trustees. And so I think in the late 80s, the community came together and formulated this land trust. And so they all put their properties, I guess, in that community bank that held control of the land. Then I think it's like a 99-year lease or something like that, or 99-year term. And so whenever individuals are looking to sell their home, they can only sell the home at the value of the home, because the land itself is within that trust and can't be sold.
And I'm assuming that there are some covenants on how much they can appreciate the land, the house going forward. They can't just sell it at fair market value.
Yes, sir.
Yeah, we've looked at that here in Rocky Mount, where we've looked at that as an option to address affordable housing in Rocky Mount. So Trudell brings up a good example. There are different types of land trusts, so it kind of gets a little complicated. But in those particular examples, because the land is being used for habitation, there is somebody on the property, the land trust would still, there've been some questions about that. It depends on the state, and I'm trying to remember North Carolina, but there are some states where they would have to pay property taxes on the land, as well as obviously taxes on the home. What can happen is they can pass that on to the buyer as part of their mortgage escrow, because typically the way these land trusts works is they facilitate the mortgages. I'm not saying all of them do that, but most of them do that. They facilitate the mortgage as to facilitate a better entry point for the buyer. So they can facilitate the payment of the taxes in escrow. There are some states, and I honestly can't remember North Carolina's rule on this, where because technically the land is held by a nonprofit, there would not be an assessment on it. The idea, of course, with these land trusts is to continue to make existing affordable owner-occupied housing available long-term. And the real challenge is that in some places it started early on, like in Durham. Durham started this early on when the homes were at a different value. But in other places, you're like Asheville's trying to do one right now. Well, Asheville's property is way overvalued. I mean, Asheville's has been an extremely hot market now for almost 15 years. And they have an entirely different challenge in the fact that they're trying to acquire property, but they're having to pay a premium for it. So they're almost having to discount the future cost of it. That's definitely an example. I also forgot to talk about personal property or business property. That's of course also in North Carolina, that is also valued for taxation purposes. And of course, the most common form of personal property that we're all familiar with that's taxed are vehicles. And again, as was brought up by Darley, you pay it based on an assumed value that's calculated based on years and mileage and resale, and that value goes down over time. So the reality is that it does go down over time, and you do have the right to appeal that value. You have the right, of course, to appeal the value, the valuation on your home, the assessment on your home if you think it's too high or too low. But the important thing to also remember is that when it comes to vehicles, for example, I forget how much of a mileage increment they take on vehicles each year. I think I want to say it's like 10 to 15,000, but some of you may be putting 20 to 25,000 miles on your vehicle. Well, you can go back to them, take a picture of the odometer and say, hey, I've put 25,000 miles on the vehicle. Does that change it? And they're supposed to say, yeah, it does a little bit. We'll give you a little bit of a discount. But that's an example where the property value is likely to depreciate as opposed to appreciate, which is typically what happens with buildings, homes, and land. Okay, are there any questions with respect to Chapter 11 on property taxes? Any further questions? Okay, so we're going to take now a slightly extended break because I want to start at 8:15, and we will rejoin at 8:15 for the lab session. So thank you all, and I'll see you all at 8:15.